students. I hope you are all fine. Today I'm going to explain some cases and questions for the topics given. Let's now answer some MCQ questions regarding contingent liabilities and subsequent events. Number 1, if a potential loss on a contingent liability is remote, very little possibility to occur, the liability usually is disclosed in the footnotes but not accrued. Not, of course, this is wrong statement. This is not, if it is remote, you shouldn't disclose it. And it's also not accrued. Number B, which is the correct statement, neither accrued nor disclosed in the notes to the statement. Of course, this is correct. Also, the number C, accrued and indicated in the body of the statement, of course, wrong. I cannot disclose it in the statement itself. Number D, disclosed in the auditor reports, of course not, but not on the financial statement. Number 2, with which of the following client personal would it generally not be appropriate to inquire about commitment or contingent liability? Of course, the auditor can inquire about commitment from the controller or the president, additionally from the vice president, but not, of course, the accounts receivable clerk. Number 3, which is the following is not considered a commitment? What is commitment first? An agreement to commit the firm to a set of fixed conditions in the future, regardless of what happened to profits or the economy. Remember that. So, in fact, an agreement to purchase raw material is a commitment. Pension plans, it means post-retirement benefits. Most companies are having a pension plans. This is also a commitment. An agreement to lease facilities at agreed upon or a set prices. Commitment. So the answer is number C, since all of the above, each one of the above is a commitment. Number 4, which of the following is not a common audit procedures used to search for contingent liabilities? Realize that which is not a common audit procedures. In fact, they are all examine letters of credit or review of internal revenue agent report, belong to tax, analyze legal expenses. They are all procedures except to examine payroll reports. So this is not a common audit procedure. So the answer is B. Let's go to number 5. An auditor has the responsibility to actively search for subsequent event that occur subsequent to, of course, subsequent to the balance sheet dates but before issuing the audit report. So the correct answer is C. The balance sheet date is not correct, and similarly the date of the auditor report. In addition, also issuing a management representation letter is not correct. So the answer is C. Number 6. Which of the following subsequent event is most likely to result in an adjustment to the company financial statement? Realize that which one is most likely. Of course, merger or acquisition, to acquire another company, doesn't need an adjustment. Also issuance of common stock, normal transaction. Uninsured losses of inventory because of fire, of course not. But bankruptcy, if you are going to liquidate the business due to deteriorating in the financial conditions of a customer with a big outstanding AR balances. Actually, this event will require an adjustment to the financial statement. Number 7, the audit step most likely to reveal the existence of contingent liability is, of course, it's not a review of a voucher paid during the month after the year end. And also, account receivable confirmation is not correct. Accounts payable confirmation is also incorrect. But the correct answer is an inquiry directed to the legal counsel of the client. So I have finished the lecture, and see you next week. Let's review some true or false statements. Number 1, an auditor performs interim work at various times during the year. It means a quarter review, of course. The auditor's subsequent events work should be extended to the dates of his report. This is actually true statement, because he should start it from client's ending balance sheet date up to auditor's report date. For subsequent events. The second one, in connection with the annual audit, review journals and ledgers is not a subsequent events procedures. Actually, this is false statements, because auditors should review both journals and ledgers to determine the existence and nature of significant transaction related to the current year. So they are used. The third one, a lawsuit has been filed against your client. If, in the opinion of the legal counsel, the likelihood your clients lose the lawsuit is remote, no financial statements, accrual, or disclosure of the potential loss would be required. In fact, this is true. because the possibility is remote. Right. Let's go to number 4. The first step in the audit of contingencies is to determine the amount of them. In fact, this is a false statement. Why? Because first he has to search whether they exist or not, the contingency. Then he will start to determine their amount. Right. Number 5, the auditor's responsibility for reviewing subsequent events is normally limited to 30 days after the balance sheet date. This is, of course, is a false statement, because it should extend it to the report date. Right. Number 6, current professional auditing standards make it clear that the CPA, not the management, is responsible for identifying and deciding the appropriate accounting treatment for contingent liabilities. In fact, this is a false statement. Why? Because actually the management, not the auditor, is responsible to both decide and identify the accounting treatment for contingent liabilities. I have finished the lecture, and best of luck for all of you.